Welcome everyone to the webinar, Unmet Materials Needs for Critical Technologies, Finding Opportunities in the Energy Transition. I'm Mike Holman, SVP and Group Director here at Lux, and moderating today's session, which is an exciting one on tackling a really important topic in the energy transition and some of the materials opportunities coming out of that, which are really important and that we talk about a lot with our clients in the chemicals and materials industry, of course, as well as in energy, oil and gas, other downstream sectors that are involved in that energy transition and what needs to make it happen. And we've got some great analysis and insight on that today from Anthony Schiavo, who's a research director in manufacturing and materials. So all throughout the webinar, you can type any questions you have in the questions box on your screen. We'll answer as many questions as we have time to at the end, but if your question doesn't get answered or you think of one later, feel free to email questions@luxresearchinc.com and we will respond. So with that, take it away, Anthony.
Thanks so much, Mike. And you're right, this is a really exciting topic, and it's one that our clients are really asking us a lot about, especially in the last 2 years. So today, I want to dig into the issue, introduce the problem, as well as go over our methodology for identifying these opportunities for materials innovation. Then we're going to go over a little technology example, focusing on hydrogen, one of the spaces we've been asked about the most. And lastly, I'll leave you with some bigger thoughts on the future of the chemicals and the materials sector. Now, I think everyone understands that we're getting to be near the limit of our ability to emit carbon. If we want to limit global warming to just 1.5 degrees centigrade, we only have about 420 gigatons of cumulative emissions left. And what that means is, being optimistic, we have about 10 years at the rate of 35 gigatons per year to really just make this energy transition work, or make substantial progress in terms of reducing our carbon emissions. For the chemicals industry, this presents both a risk and an opportunity. The risk is really in decarbonizing operations. The chemicals industry is a major emitter, both from their process emissions, things like steam reforming, as well as their emissions from combustion. However, there's a substantial opportunity here to access new markets, particularly these new material needs for the energy transition. And this is a good opportunity because there's a match between the timeline of the energy transition, this 10-year period, as well as the timeline of materials innovation. Materials innovation, historically, it takes a really long time. It's slow. Taking something from academic space to commercialization is typically 20 years. And even for startups, you're looking at a 5 to 7 year commercialization timeline. One of the big issues has been just markets often move more quickly than materials innovations. But here, there's a lot of alignment in terms of timeline. Today, we're really going to be focusing on this second opportunity around accessing new markets. But next month, we have a webinar I'll also be leading called Decarbonization Darwinism. It's really going to be focused on the risk. So I encourage you to join us then, and I encourage you to recognize that these two issues are fundamentally linked. And it's important, the issue of materials is important not just for materials and chemicals companies, but for everyone who cares about the energy transition, because it's these materials that are going to enable and unlock the potential of that transition. Okay. We see innovation leaders as having 3 major objectives when planning for the energy transition. First, they need to identify these opportunities for materials. That's crucial, and it's not necessarily easy either. Second, once they've figured out what the materials opportunities are, they have to understand the timing. I know we talked about this idea of the timing matching up, but there are definitely nearer term and longer term opportunities for materials innovations. So you want to be sure that your innovation strategy matches the timing of the market. And lastly, you need to understand risk. Every company has a different appetite for risk, and innovators are responsible for making a portfolio of innovations that matches their company's ultimate appetite for risk. So our approach combines really the expert opinion and the primary research with data analytics. We started by speaking to Lux's own experts on the energy transition, our analysts covering, hydrogen technologies, utilities, oil and gas. And we asked them what the pain points and what the key issues were for those energy transition technologies. From that, we drew up a list of technology candidates. These are material technologies that are potential enablers or enhancers for that energy transition. Then we did two things: a Lux Tech Signal analysis, which will help us understand timing, and a scorecard evaluation that will help us understand risk. We brought the results of those analyses back to the experts, made adjustments, made sure that we were aligned with their views on the future of the markets. And that all informed our final evaluation. To dig in a little deeper on the methodology, what you see on the left here is the Lux Tech Signal. This is a combined benchmark of innovation activity, drawing on data in patenting, paper publication, government and VC funding, as well as our own proprietary data sets. In this analysis, we're going to look at three factors. The first is the momentum, which is the current strength of innovation activity in a space. And generally speaking, we see higher momentum as correlating with nearer term commercialization. The second thing we're going to look for is inflection points. These are changes in the rate of activity in the tech signal. Technologies often undergo commercialization or innovation cycles, where there's a big boom and a bust. Here you really see this reflected in the inflection points in the tech signal. The one on the left is for metal organic frameworks. And you can see there's a second inflection point right around that 2012-2013 timeframe. That's when a lot of the initial startups were founded. We often see that, technologies become commercially ready around 4 to 7 years after that first inflection point, that second inflection point. And that was the case with metal organic frameworks, with initial tests happening in 2017, 2018, and further commercial tests for things in applications like carbon capture starting in the 2020s. The last thing we look at is volume, the total amount of activity in terms of patenting and papers. And this gives us an opportunity to compare these technologies against each other, as well as it gives us the chance to really understand the fundamental maturity of the underlying approach. The second thing is the risk evaluation. We looked at two kinds of risk: transition risk and market risk. So this transition risk really seeks to ask, how risky is this part of the energy transition? And this is important because some technologies like wind and solar are basically risk-free. It's almost impossible to imagine a future energy transition that doesn't include a lot more wind and solar energy. Some other parts of the energy transition, like hydrogen or ammonia energy carriers or nuclear power, are a lot more risky. There's a future where those technologies don't really come to fruition. So we analyzed government support, industry buy-in, and the maturity of the fundamental energy technologies to understand the risk from the energy transition as a whole. The second thing was market risk. This really asks the question, what's the opportunity for this specific material technology? Assuming this energy transition does occur, how much of this material can you really sell? Well, what's the risk there? Here we looked at the potential performance improvement from the material, as well as willingness to pay in the market and the competitive landscape. Okay, we take all this risk, timing, opportunity, and we put it all together in our Lux Materials Opportunity Roadmap. This horizontal axis captures the timing of commercial adoption. This vertical axis captures the potential market opportunity for materials. And the color of the border indicates the risk. And we'll be using this to analyze the opportunities and the different material technologies that we're uncovering in this analysis. Okay. Our team of analysts identified 5 priority areas: batteries, the hydrogen economy, decarbonization, electric vehicles, and wind energy, where we really saw materials innovations as playing an important role and impacting the future development of technology. Now, I want to focus in on just one of these today, the hydrogen economy. And this is going to give a great example of why, combining some of that data as well as the insight is really crucial. This is the tech signal for the hydrogen economy material technologies. And you can see we've identified 7 technologies that we think are really crucial. You can really see the history of the hydrogen space in this technology signal. There's this group of 3 technologies: low-cost fuel cell catalysts, fuel cell separators, and hydrogen membranes, which have a distinct peak in 2006 and a much higher level of activity overall. This really reflects a time in the mid-2000s when folks thought that the fuel cell vehicle was the clean vehicle of the future. You can see in the mid-2010s, those technologies really trended downwards in terms of their innovation activity as electric vehicles began to dominate the passenger vehicle conversation. Then there's this group of other technologies which are much lower on the tech signal. These are technologies whose innovation activity is below average. However, there's been kind of a slow and steady development, and a lot of these technologies really support the infrastructure of the hydrogen economy. Things like pressure vessels, hydrogen carriers, piping. As more and more of the conversation turned to industrial hydrogen in the late 2010s, we began to see a distinct uptick in innovation activity in these more infrastructural types of areas. And this reflects the overall innovation focus that we see today. Now, when we map these material opportunities on the outlook or the opportunity map, we see that there's a lot of medium and small size opportunities, but it's a relatively low risk area. You've got things like separators, catalysts, and hydrogen carriers, where there's a clear set of government support as well as a clear opportunity for willingness to pay. If you can really make a much better fuel cell catalyst, people are definitely going to want to pay for that. However, I want to dig into one of the bigger opportunities here, which is novel pressure vessels. Coming back to the tech signal, what you can really see is that this technology has, on the tech signal, not had a very sort of exciting trajectory. It's been relatively low throughout the 2010s, and we only really began to see that first inflection point in the sort of 2016 timeframe. So this isn't a space that has had a big influx of funding, a big influx of startups, or a big influx of hype. And it's what we like to think of as a hidden gem. That doesn't mean there's no opportunities for innovation or venturing in this type of space. There's a lot of companies, or there is an innovation ecosystem, I should say. Maybe not a lot of companies, but there are startups working on these technologies. And a good example of that is Steelhead Composites. This is a company that produces a composite overwrapped pressure vessel. So there's actually a steel pressure vessel underneath that fiber overwrapping. And this type of approach allows a good balance in terms of the price as well as performance. It's cheaper than a all composite tank, but it's lighter weight than a pure steel tank. And what's interesting is this company was founded in 2012. They were targeting natural gas for a long time, and they actually, achieved profitability as early as 2019. They recently raised their first round of funding after being profitable to expand their production and really focus in on this hydrogen opportunity. So, this is a company that is, in a lot of ways, is very mature. They have a clear product. They have a clear advantage. They have the ability to operate and make a profit. And now they're entering this, this type of more venture mode where they're raising money to expand production. And I think this reflects that in a lot of these material spaces, these types of companies and innovators can fly under the radar. But the tech signal can really help to uncover, and as well as discussions with our analysts, really uncover these opportunities that may be a great fit for companies with resin, fiber, or manufacturing approaches. We could talk about any of these technologies. There's a huge number. We could spend all day here going through this whole chart. But I just want to leave you with a couple sort of major highlights when we look at the overall innovation space. The first is that a lot of the technologies are in this 2025 to 2030 to beyond 2030 categories. Like I said earlier, this is great from a timing perspective. There's a lot of opportunities for fundamental R&D here in areas like catalysts, heat batteries, hydrogen carriers. And so material companies can really take their time and develop those technologies that are going to be fundamentally advantaged. Then, secondly, there's a lot of opportunities for different risk appetites. You can build a strategy that's very low risk, only focusing on areas where there's a guaranteed to be a market. Things like battery recycling, carbon capture sorbents, things like battery pack thermal management for EVs. Or, you can spread your bets, taking some low risk opportunities, but adding high risk opportunities like heat batteries or direct lithium extraction. And in addition, you can also build an innovation portfolio that's balanced in terms of timing, taking early stage opportunities, maybe in battery additives, and balancing that with longer term opportunities in energy infrastructure, things like piping, hydrogen carriers. So this is really, I think, in a lot of ways, a very positive outlook for chemical companies. There's a lot of opportunity here to really build an innovation strategy that matches your organization's goals. However, I want to bring it back to this dichotomy, this challenge here. We've looked at this, we've talked about these opportunities here in accessing new markets. But chemical companies are still going to have to decarbonize. When you look at these new opportunities from the energy transition, this adds up to maybe $100 billion of new markets for materials. So it's pretty substantial. But the existing chemicals industry is much larger. It's in that $4 trillion range. And the headwinds from things like plastic bans and the need to recycle or carbon taxes are going to really substantially impact that existing market. And they're going to more than outweigh this new opportunity from the energy transition. To put it in simpler terms, if market demand for commodity plastics drops by 10 or 20% over the next 10 to 20 years, that's not going to be offset by these new opportunities. So if you're a smaller, maybe $5 to $10 billion specialty chemical company, that doesn't matter. This is a great opportunity for you. You can pick and choose your areas in the energy transition, really focus on your strengths, and deliver on a lot of new product opportunities. But for more integrated chemical companies, they're going to really struggle to offset the damage caused by issues of climate change and decarbonization and circularity to their businesses. And if you want to hear more about that, I encourage you to join us next month for Decarbonization Darwinism. But now I just want to leave you with a few more thoughts. First, like I said, energy innovation timelines match materials innovation timelines. So there's a great opportunity here for fundamental R&D because we have that vision into the future that's really going to allow us to bring better performing material technologies to market. Secondly, there are lots of $100 million and $1 billion opportunities, but only a couple blockbusters. Those blockbusters are going to be pretty contested as well. So for companies, in a small to mid-sized specialty chemical range, they're going to have a really good time tackling these $100 million and $1 billion spaces. But you're still going to have to find a way to decarbonize your operations and do it in a way that's profitable, because business as usual is not going to be made up by these new opportunities in the energy space. And with that, I want to thank you, and I want to encourage you to join our future webinars, and we'll open it up for questions.
All right, thank you very much, Anthony, for the presentation, and we do have a few questions from the audience coming in here. Maybe first, just to look at the methodology. So, overall, why these 5 particular tech areas? There's a couple others you referred to through the course of the presentation, like solar, wind, nuclear, that weren't highlighted here. What was the reason behind selecting these 5?
Yeah, so these are areas where we felt like materials had a big opportunity to be a pivot point, and that the underlying energy technology was going to be really critical. So taking solar as an example, of course, that's going to be critical to the future, but we didn't really see materials innovations as being highly impactful. There are some coatings, of course, there's some next generation solar technologies, but that's really a commoditized space. Something like nuclear, it's not really clear to us that it's going to be a huge impact on the overall energy transition.
Mm-hmm. And maybe along those lines, one of the other areas that you didn't, was on the list, was among those 5, but that we didn't dive into as much here was electric vehicles. So what are some of the areas that you see the most opportunity in related to EVs?
Yeah, the last decade, I think, in EVs has really been focused on bringing down the costs of batteries and driving as many batteries into the vehicle as possible, getting as much energy density there. And that has obviously been in response to issues of range and cost, but it's created, I think, a situation where there's a lot of unreliable electric vehicles in the market. We're seeing a lot of recalls, potentially battery fires. So we see the next decade is really being more focused on reliability and safety. So technologies like, battery thermal management really speak to that issue. A bit longer term, we expect that the focus is going to shift more towards the total impact of the car, including manufacturing and materials, and away from tailpipe emissions as the electric vehicle revolution, really takes market share. That means more opportunities for things like bio-based or recycled materials as issues of end of life and sustainable sourcing become more important.
Yeah, I think that's been something that's starting to become evident, right? As much as with an ICE vehicle, a lot of the impact comes from the fuel, right, and the emissions. Yep. But with an EV, a lot more of the impact comes from the critical minerals and materials, the nickel, and other copper and other elements that have to go into that, and similarly for a lot of other projects and products in the energy transition. Then another attendee who was encouraging to see that you have the CO2 sorbents coming in the 2025 to 30 range, but wanted to know how we would rate CO2 valorization, with the thinking being that it's hard to imagine that market for CO2 absorbents developing in a sustainable way without some valuable use to convert the CO2 into on the other end.
Yeah, that's a good question. And we could do a whole talk on the technologies we didn't include on the chart as well as the ones we did, right? I think ultimately, we did put CO2 mineralization here on the map, and that's a technology we think is important, and a near-term opportunity. But other technologies like CO2 to polymers or CO2 to carbons, we really see those as much longer term, really 2035 to 2040 before the markets truly develop. And that's just a result of the fundamental cost effectiveness of the technology. So I see us being much more in a carbon capture and storage type of regime for the next decade rather than a carbon capture and utilization.
Right, with the sort of concrete mineralization applications aside.
Yeah, that's sort of an outlier there.
And maybe time for one last question, and just sort of a bigger picture. What do you think this ultimately means? I mean, you talked about the divide here, these two different sort of forces from the energy transition impacting the industry. What is that ultimately going to mean for industry structure? Right, we've seen a lot of mergers and spin outs and divestments and things from companies. You've got, Solvay recently announced it's going to be splitting into two organizations, which I think are going to be affected very differently by the trends. One more base chemicals focused, the other more specialties focused, right? So how do you see this overall impacting that kind of industry structure and M&A outlook?
Yeah, I mean, I think you kind of touched on this, but it's going to be very different for specialty chemicals versus commodity chemicals, right? A lot of integrated chemical companies, their emissions are coming from maybe a quarter of their business, the bulk of their emissions, right? So to decarbonize a business like that, you're essentially having to take money both away from shareholders, but also away from those sort of low carbon parts of the business. So like Solvay, I think we're going to see more and more companies begin to split up, creating emissions heavy companies focused on commodities and, the more profitable, potentially more lower emissions sort of specialty chemical companies as well. So it's really going to be a lot of that sort of structural change.
Yeah. Yeah, and I think we'll probably be talking a lot more about that. I anticipate in that next upcoming webinar in August. Yeah. So yes, please be sure to come back and join us for that, as well as for these other upcoming webinars that you see on the slide here. And thanks to all of you for joining us for this. We will send around the presentation and recording to all the attendees. You should get an email with that later on today. And after you leave the webinar, you will be prompted to complete a survey about the presentation today. We really appreciate if you could take a few minutes to let us know your thoughts there. We really look at those closely and try to use that feedback to improve future webinars. So thank you again for the presentation, Anthony. Thanks to everyone for joining us, and have a great rest of the day.
Thank you.